It might surprise you to hear this, but you don't actually need a fortune to start building wealth. You don't need a high-paying job, a lucky break, or a rich relative. All it takes is $500 a month and the discipline to invest it wisely for the next 20 or 30 years. I know this because I've seen it happen, starting from almost nothing. I'm going to share with you what I would do if I had to start over, armed with just $500 a month. This isn't some abstract theory. It's the practical plan I'd put into action if everything I've built over these past 7 decades vanished tomorrow. Let me take you back to 1956. I was 25, newly married, and launching my first investment partnership. I didn't have wealthy backers or institutional money. I had 7 partners, mostly family and friends, who contributed $105,000 collectively. My own contribution, just $100. I wasn't the rich one in the room. I was the one with the ideas and the discipline. Over the next 13 years, that partnership grew at an average rate of nearly 30% per year. An initial investment of $100,000 would have ballooned to over $2.5 million by the time I closed it. We didn't have secret information, nor did we take wild risks. We simply applied consistent principles to every investment decision, month after month, year after year. I remember those early days in our small Omaha office. I'd arrive each morning poring over stacks of annual reports, searching for businesses selling for less than they were worth. My partners trusted me with their money, a responsibility I took seriously. Every dollar they contributed felt like my own. Looking back now, what strikes me is how little the fundamental principles have changed. The businesses, the technology, the scale, they're all different. But the core truth remains: consistent investment in quality assets, maintained with discipline over the long term, yields extraordinary results. The amount you start with is far less important than the habits you develop and the principles you adhere to. Investing $500 a month wisely over 30 years can absolutely transform your financial life. And I'm going to show you exactly how. The very first thing I would do with that $500 each month is establish an unbreakable habit of investing. Not saving, investing. There's a critical distinction. Saving means setting money aside, often in a bank account earning next to nothing after inflation. Saving is necessary, but it's not enough. Money in a savings account slowly loses purchasing power as inflation erodes its value. Investing, on the other hand, means putting your money to work, buying ownership stakes in productive assets that grow over time. When you invest in stocks, you're buying pieces of real businesses with real employees, making real products that real customers pay real money for. These businesses grow, their profits increase, and your ownership stake becomes more valuable. The habit I would build is automatic investment on the first day of every month. Not when I feel like it, not when the market looks good, not after I've paid for everything else. First, before rent, before entertainment, before anything discretionary, the $500 goes into investments automatically, and I learn to live on what remains. This automation is crucial because it removes emotion and decision-making from the equation. You don't have to convince yourself to invest each month. You don't have to overcome the temptation to spend the money on something else. The money moves automatically, and you adjust your lifestyle to accommodate what's left. I learned early on that the most successful investors are those who make investing non-negotiable. It's not something they do when it's convenient. It's something they do no matter what. Through good months and bad months, through market crashes and market booms, through job changes and life changes, the investment continues automatically. Now, let me tell you exactly where I would put that $500 each month. If I were starting over today, I would put every dollar into a low-cost S&P 500 index fund, not individual stocks, not actively managed funds, not complicated strategies, a simple, boring index fund that tracks the 500 largest companies in America. I know this might sound surprising coming from me. I've spent my entire career picking individual stocks. I've built one of the largest fortunes in history by identifying undervalued businesses and holding them for decades. So why would I recommend something as simple as an index fund? Because I'm being honest about what works for most people. Stock picking requires enormous amounts of time, knowledge, and temperament. You need to read annual reports, analyze competitive positions, evaluate management teams, and understand industry dynamics. You need to remain rational when everyone around you is panicking or euphoric. Most people can't do this successfully while also working a job, raising a family, and living their lives. An index fund gives you ownership in 500 of the best businesses in America without requiring any of that work. You own a piece of Apple, Microsoft, Amazon, Google, Johnson & Johnson, Procter & Gamble, and hundreds of other excellent companies. As these businesses grow and prosper, your investment grows with them. The S&P 500 has returned approximately 10% per year on average over the long term. There's a kind of magic in consistent investing, a magic that builds slowly, almost imperceptibly, and then accelerates into something truly unstoppable. I'm talking about the power of compound growth over time. Imagine turning just $500 a month into over $1 million. It's not a dream, it's the mathematics of long-term investing. Now, let me show you what I mean. If you invest $500 a month and get an average annual return of 10%, and that's a reasonable average over long periods, even though some years might be up 30% and others down 20%. The numbers become quite compelling. After 5 years, you would have around $39,000. After 10 years, approximately $103,000. After 20 years, it grows to about $380,000. And after 30 years, you could have over $1 million. That's from simply investing $500 a month, and it assumes you never increase your monthly investment. If your income grows and you gradually increase your investment from $500 to, say, $700 a month, the final number becomes substantially larger. Start earlier, invest for longer. The number grows even more dramatically. Time, you see, is your greatest asset in this game. A 25-year-old who invests $500 a month until age 65, giving their investments 40 years to grow at 10% annual returns, could end up with over $3 million. It's not magic. It's simply the result of consistent investing over long periods. The power of compound growth often isn't truly grasped until you see it in action. In the early years, the growth can seem painfully slow. After 1 year of investing $500 monthly at 10% returns, you might have only about $6,300, with just $300 of that being investment returns. It hardly seems worth the effort. But remember, compound growth is exponential, not linear. Each year, your returns generate their own returns. After 10 years, you might have contributed $60,000, but your portfolio could be worth over $100,000. The investment returns now exceed your contributions. The snowball is building momentum. After 20 years, you've contributed $120,000, but your portfolio could exceed $380,000. Your investment returns are now generating over $30,000 per year, more than half of what you contribute. The snowball is rolling downhill, gathering mass with every turn. After 30 years, you might have contributed $180,000, but your portfolio could exceed $1 million. Your annual investment returns now exceed $100,000 per year. The snowball has become an avalanche. You are now earning more from your investments each year than many people earn from their jobs. This is the essence of compound growth. It starts slowly, almost imperceptibly, and then it accelerates and becomes unstoppable, but only if you give it time. Every year you delay is a year of compounding you will never get back. Albert Einstein is often credited with calling compound interest the eighth wonder of the world. Whether he actually said it or not, the sentiment is accurate. Something almost magical about the way money multiplies when left to grow undisturbed over long periods. It is the closest thing to a guaranteed path to wealth that exists in the financial world. But here's something else that is critically important: low costs. When you invest in a fund, you pay fees, usually expressed as an expense ratio, a percentage of your assets that the fund company takes each year to cover their costs and profits. The difference between a high fee fund and a low fee fund might seem small, perhaps just 1% per year, but over decades, that difference compounds into an enormous sum. Imagine two investors who both invest $500 a month for 30 years, both earning gross returns of 10% before fees. Investor A uses a low-cost index fund with an expense ratio of 0.03%, while Investor B uses an actively managed fund with an expense ratio of 1%. After 30 years, Investor A could have approximately $1 million. Investor B might only have around $900,000. That 1% difference in fees cost Investor B over $200,000, money paid to fund managers who, by the way, almost certainly did not beat the index anyway. Now let's talk about something equally important as where you invest, how you behave as an investor. This will determine your success or failure more than any other factor. The biggest threat to your wealth is not market crashes or economic recessions. It is your own behavior. The average investor earns returns far below what the funds they invest in actually generate. How is this possible? Because people buy and sell at exactly the wrong times. When the market is soaring and everyone is making money, greed takes over. People pour money into stocks at high prices, convinced the good times will continue forever. When the market crashes and panic spreads, fear takes over, and people sell their stocks at low prices, convinced the world is ending. Buy high, sell low. It is the opposite of what intelligent investing requires, yet it is what most people do. If I were starting over with $500 a month, I would commit to never selling based on market conditions. Never. The money goes in every month, regardless of whether the market is up or down. I would not check my account obsessively, and I would not watch financial news channels constantly fueling anxiety. I've seen fear make people do strange things with their money. I've watched them sell low, convinced the world was ending only to miss the recovery entirely. It's a pattern I've observed time and again. That's why I believe behavior matters far more than trying to pick the next hot stock or perfectly time the market. Let me tell you about the financial crisis of 2008 and 2009. The market plummeted, retirement accounts were devastated, and the news was filled with predictions of a new Great Depression. Fear was everywhere. Many investors panicked and sold their stocks, locking in massive losses, unable to stomach the daily decline. They were convinced things would only get worse. But those investors who kept buying, who consistently put their money into the market month after month, even as prices fell, they did extraordinarily well. They were buying shares at bargain prices, and when the market recovered, as it always does, those shares dramatically increased in value. The S&P 500 bottomed out in March 2009 and then delivered one of the greatest bull markets in history. Those who stayed the course and kept buying saw their wealth multiply many times over. The investor who consistently invests through good times and bad will almost always outperform the one who tries to time the market. even if that market timer is more intelligent or has better information. Here's a strategy I find helpful for managing behavior during market downturns. When the market is falling and you feel the urge to sell, do the opposite. Increase your investment if you can. If your normal investment is $500 per month and the market drops 20%, try to invest $600 or $700 that month. It feels counterintuitive, I know. Every instinct tells you to protect what you have when prices are falling, but falling prices are good news for someone accumulating shares. You're buying the same businesses at lower prices. Your $500 buys more shares when prices are down than when prices are up. Think of it like any other sale. If your favorite store had a 20% off sale, would you avoid the store because prices had dropped? Of course not. You'd take advantage of the lower prices. Yet when stocks go on sale, most investors run away instead. Now, as your wealth grows, the strategy evolves. When you're starting out with just a few thousand, simplicity is key. One index fund is all you need. There's no point in diversifying across multiple funds or asset classes when your portfolio is small. The benefits of diversification are outweighed by the complexity and the temptation to tinker. As your portfolio grows into the tens of thousands and eventually hundreds of thousands of dollars, you can begin adding additional elements. Once I had accumulated perhaps $50,000, I added an international stock index fund. Maybe 20% of new contributions went to an international fund, while 80% continued going to the S&P 500. This provides expo to companies outside the United States, which occasionally outperform American stocks for extended periods. Once I had accumulated perhaps $100,000, I considered adding a small allocation to bonds, maybe 10% of the portfolio in a total bond market index fund. Bonds provide stability during stock market downturns and generate income that can be reinvested. They reduce the overall volatility of the portfolio, which makes it easier to stay the course during difficult periods. But these additions are refinements, not requirements. An investor who simply puts $500 a month into an S&P 500 index fund for 30 years and never touches it will do extraordinarily well. The additional diversification provides modest benefits, but it's not essential. The core principle remains the same throughout. Invest consistently in low-cost funds that provide broad market expo. Do not try to pick individual stocks or time the market. Control your behavior and stay invested through volatility. Let compound growth work its magic over decades. Now, some common questions might be running through your mind. What if you can't afford $500 a month? Start with whatever you can afford. $100 a month is better than nothing. $200 is better than $100. The principles work at any amount. The key is building the habit and maintaining consistency as your income grows. Increase your investment amount as you can. What if you need the money for an emergency before you begin investing? Build an emergency fund of 3 to 6 months of expenses in a savings account. This money is not for investing. It's insurance against life's unexpected challenges. Once you have this cushion, you can invest your money with confidence, knowing that short-term emergencies will not force you to sell your investments at inopportune times. What about paying off debt? High-interest debt, like credit card debt, should be paid off before you begin investing. If you're paying 18% interest on credit card debt, paying off that debt is equivalent to earning 18% on your money, a guaranteed return better than any investment can offer. But once high-interest debt is gone, you should invest rather than aggressively paying down low-interest debt like mortgages. The math favors investing when interest rates are low. What if you're older and don't have 30 years to start? Start anyway. 20 years of compound growth is better than 10. 10 years is better than 5. 5 years is better than keeping your money in a savings account earning nothing. The best time to start investing was 30 years ago. The second best time is today. What about retirement accounts like 401k plans and IRAs? Use them. These accounts provide significant tax advantages that accelerate your wealth building. If your employer offers a 401k match, contribute at least enough to capture the full match. That's free money you shouldn't leave on the table. The power of tax-advantaged accounts is something I think many people don't fully appreciate. I know I didn't at first. Imagine being able to invest money where the government, in a way, subsidizes your investment, and then that money grows without you paying taxes on dividends or capital gains each year. It's a truly remarkable opportunity. In a traditional 401k or IRA, your contributions are tax deductible. If you're in, say, the 22% tax bracket and contribute $500, you save $110 in taxes right away. It's like the government is giving you a little boost. The money then grows, tax deferred, and you only pay taxes when you withdraw it in retirement, hopefully at a lower tax rate. Now, with a Roth IRA, it works a bit differently. You contribute after-tax money, so there's no upfront tax deduction. But the magic happens when the money grows completely tax-free. When you withdraw in retirement, you pay absolutely zero taxes on the gains. Imagine your $500 per month growing to $1 million over 30 years. You can withdraw that entire million without paying a penny in taxes. Let me give you a concrete example. Imagine you invest $500 each month in a Roth IRA for 30 years, earning 10% annually. You contribute a total of $180,000, but your account grows to over $1 million. That gain of over $900,000 is completely tax-free. Now imagine instead you had invested in a regular taxable account. You'd pay taxes on dividends each year, reducing your returns. And when you sell, you'd pay capital gains taxes on that $900,000 in gains. At a 15% capital gains rate, that's $135,000 in taxes. At 20%, it's $180,000. And the Roth IRA saves you well over $100,000 in taxes. That's real money that stays in your pocket, not going to the government, and all it requires is using the right type of account. The difference between investing in tax-advantaged accounts versus taxable accounts can amount to hundreds of thousands of dollars over a lifetime. It's not complicated tax planning. It's simply using the accounts that Congress has made available to encourage retirement saving. What I've found is that many people are held back from starting to invest by the fear of making mistakes. They worry they'll pick the wrong fund, invest at the wrong time, or make some other error that will cost them dearly. This fear can paralyze them into inaction. They keep meaning to start investing, but never quite get around to it. The months pass, then years, then decades, and the cost of inaction far exceeds the cost of any mistake they might have made. Here's what I've learned. If you follow a simple strategy, investing consistently in low-cost index funds and staying the course through market volatility, you'll likely do just fine. You don't need to pick the perfect fund. Any broad market index fund will work. You don't need to time your entry perfectly. Dollar cost averaging by investing the same amount each month smooths out the timing. You don't need to be a financial expert. The strategy requires no special knowledge or skill. The biggest mistake is not starting. Every month you delay is a month of compound growth you'll never get back. A 25-year-old who waits until 30 to start investing loses 5 years of compounding that can never be recovered. Waiting even a few years dramatically reduces the final outcome. So start now, start today, start with whatever amount you can afford. You can always optimize later, but you cannot recover lost time. Let me share some thoughts on lifestyle and spending because this is intimately connected to your ability to invest. The people who successfully build wealth are not usually the highest earners. They are the people who maintain a gap between what they earn and what they spend. They live below their means. They avoid lifestyle inflation, that tendency to increase spending whenever income increases. They find satisfaction in experiences and relationships rather than material possessions. I've lived in the same house in Omaha since 1958. I bought it for $31,500. I could have afforded any mansion in the world, but this house has been enough. It has been more than enough. The money I didn't spend on a larger house was invested, and that investment grew into something far more valuable than any house could be. I drive a modest car. I eat at the same restaurants I've always enjoyed. I wear comfortable clothes that are far from fashionable. None of this is deprivation. It's simply a recognition that beyond a certain point, spending more does not increase happiness. The marginal utility of consumption diminishes rapidly once your basic needs are met. I've watched many people earn high incomes and end up with nothing. Doctors, lawyers, executives who made hundreds of thousands of dollars per year, but spent every penny and more. They financed expensive cars, bought houses they could barely afford, took lavish vacations, and accumulated credit card debt. Despite their impressive incomes, they retired with little or nothing saved. On the other hand, I've watched people with modest incomes build substantial wealth. Teachers, nurses, small business owners who earned perhaps $50,000 or $60,000 per year, but consistently saved and invested. They drove used cars, lived in modest homes, took camping vacations, and avoided debt. After 30 or 40 years, they accumulated portfolios worth $1 million or more. The difference wasn't income. It was the gap between income and spending. That gap is what creates investment capital. Without that gap, no amount of income is sufficient to build wealth. I'm not suggesting you live in deprivation. I'm suggesting you think carefully about what actually makes you happy and spend your money accordingly. Most people discover that beyond a certain point, additional spending does not increase happiness. The third car does not make you happier than the second. The designer clothes do not make you happier than quality basics. It's not about the money. That's the most important lesson I've learned about building wealth. The money is just a tool. It's about what the money enables. Time with people you love, experiences that enrich your life, the ability to help others, the security to take risks and pursue dreams, the freedom to live life on your own terms. A restaurant, no matter how expensive, doesn't necessarily bring more happiness than a good meal at home with the people I cherish. Recognizing this simple truth, finding $500 a month to invest becomes less of a sacrifice. It's not about depriving myself, but rather redirecting resources from fleeting pleas to investments that promise long-term security and freedom. Let me tell you what $500 a month consistently invested can ultimately provide. It's the real payoff for decades of discipline, financial independence. It's the ability to wake up each morning and choose how to spend my day rather than being dictated by someone else's requirements. It's the security of knowing that unexpected expenses won't derail my life and the freedom to help family members in need without jeopardizing my own stability. When my investments generate enough income to cover my expenses, I am truly financially free. The job becomes optional, the boss loses control, and I can pursue work that I find meaningful rather than just work that pays the bills. This freedom is within reach for almost anyone willing to invest consistently over the long term. It doesn't demand a high income or investment genius. It simply requires discipline, patience, and an understanding that small amounts invested consistently over long periods produce extraordinary results.